Good morning, this is TOI Japan Market Radio. I'm your host in Tokyo, and today is Sunday, January 12, 2026. We bring you daily insights on Japan's equity, currency, and bond markets for global investors managing Japan exposure or monitoring opportunities in the region. Joining me today is our portfolio manager focusing on Japanese macro. Thanks for being here.
Thanks for having me. Before we dive into the news flow, I should note that Japanese markets were closed today for a holiday, so we don't have fresh equity or bond session data to report. That said, there's been significant developments overnight in US markets that will have clear implications when Tokyo reopens tomorrow, particularly around dollar weakness and financial sector stress. So today's discussion will focus on how those offshore moves are likely to filter through to Nikkei, Topix, the yen, and JGB yields.
Understood. Let's jump straight into the headlines then. Bloomberg is reporting that the dollar weakened notably after the Federal Reserve was served with subpoenas. This is creating uncertainty around Fed independence and policy direction. Can you walk us through what actually happened here and why it matters for Japan?
Sure. The core development is that the US Federal Reserve has been served with subpoenas, likely tied to some legal proceeding or investigation. The precise details aren't fully clear yet, but the market's reaction tells you what matters most. Investors are questioning Fed autonomy. Any threat to central bank independence is a big deal because it undermines confidence in the credibility of monetary policy. For Japan, this creates three key channels of impact. First, policy uncertainty in the US complicates global capital flows and risk appetite. Second, a weaker dollar directly affects yen dynamics, typically strengthening the yen as investors reassess their dollar positioning. Third, uncertainty around Fed credibility can affect US Treasury yields, which in turn influences the relative valuation between US Treasuries and Japanese government bonds.
So when you think about Japanese equities, specifically the Nikkei and Topix, what's the likely direction when markets reopen tomorrow?
I'd expect mixed to negative pressure. The weaker dollar is a direct headwind for Japanese exporters, who generate significant revenue overseas and convert those earnings back into yen. A stronger yen compresses those profit margins when reported in yen terms. Beyond that, if this Fed development triggers broader risk-off sentiment, which it appears to be doing, that typically spills over into Asia, and Japan's export-heavy equity market is particularly vulnerable. So I'd be watching names in autos, electronics, and machinery closely.
And on the currency side, USD, JPY?
Downward pressure on the dollar, which means yen strength. This is the most direct mechanic from the story. If the dollar continues weakening on Fed credibility concerns, you'd expect carried trade positions funded in yen to become less attractive. That could accelerate yen buying, especially if risk appetite deteriorates further and investors move into safe haven assets. From a positioning standpoint, a lot of global macro funds have been short yen, so if this narrative persists, you could see some covering that amplifies the move.
Staying with the currency theme, how do you see this playing into JGB yields and Bank of Japan expectations?
JGB yields likely drift lower. In a risk-off environment with US Treasuries potentially rallying on flight to quality flows, Japanese government bonds tend to follow that bid. Additionally, if this raises recession fears or growth concerns in the US, that narrows the policy rate differential between the Fed and the BOJ, which has been one of the structural drivers keeping the yen weak. So from a yield perspective, I'd expect some downward bias, though obviously the BOJ's own policy stance remains a countervailing force. They've been inching toward normalization, but external shocks like this can slow that process.
Let's shift to another major story making waves. President Trump has proposed capping credit card interest rates, and that's triggered a significant sell-off in financial sector stocks globally. What's the concern here from an investor's perspective?
The concern is pretty straightforward: net interest margins. Credit card lending is one of the most profitable revenue streams for banks and credit card issuers. If the government caps the rates they can charge, that directly compresses margins and reduces profitability in a key business line. For U.S. financials, this is a material hit. But the reason this matters for Japan is the spillover effect. When you see a financial sector sell-off in the US, it typically triggers broader equity weakness globally as investors reduce risk exposure across all markets. Japanese banks and insurers with US exposure or global operations will feel that pressure.
So beyond the immediate financial sector impact, are there broader implications for Japanese equities and the macro outlook?
Absolutely. One is the reduced US growth outlook. If credit card rate caps dampen consumer credit availability and spending in the US, that's a headwind for global growth. Japan's economy is heavily reliant on exports, so weaker US consumer demand eventually flows through to Japanese exporters. The other piece is carry trade reassessment. Lower returns in US financial assets, combined with dollar weakness, reduce the attractiveness of USD-denominated investments. That affects yen carry trade dynamics and could support yen strength, which, as we discussed earlier, is a negative for export-heavy Japanese equities.
On the policy side, does this change how you think about the Bank of Japan's trajectory?
It complicates things. If US growth concerns intensify and the Fed is seen as potentially less independent or less hawkish than previously expected, that reduces the pressure on the BOJ to tighten aggressively. The BOJ has been very cautious about normalizing policy, and external shocks like this give them more justification to move slowly. At the same time, if the yen strengthens significantly, that eases some of the inflationary pressure Japan has been experiencing from imported goods, which again reduces the urgency for BOJ rate hikes. So net-net, this probably delays any meaningful tightening cycle from the BOJ.
Shifting back to equities, Reuters is reporting that Wall Street futures are slipping on worries over Fed independence, with financial stocks particularly weak. This seems to tie together both stories we've been discussing. How should global investors with Japan exposure be thinking about this moment?
I think the key question is whether this is a tactical correction or signals something deeper about Fed credibility. If it's the latter, that has significant implications for yen positioning and Japanese equity valuations. In the near term, expect volatility. Japanese equities will likely open weaker in sympathy with US futures, and the yen will probably strengthen further if risk-off sentiment persists. For global investors, this is a moment to reassess portfolio hedges, particularly currency hedges on Japan exposure. If the yen continues strengthening, unhedged positions will see that currency drag on returns.
What about sector positioning within Japanese equities? Are there areas that might hold up better or worse in this environment?
Defensives will likely outperform. Think utilities, telecoms, domestic consumption plays that aren't as exposed to currency swings or global growth concerns. On the other hand, exporters, especially in autos and industrials, will face the dual headwind of yen strength and weaker global demand outlook. Financials are also vulnerable given the global sell-off in the sector and concerns about bank profitability both in the US and by extension Japan. Japanese regional banks in particular have thin margins to begin with, so any narrative around financial sector stress globally wants help sentiment there.
Before we wrap up, let's recap the main themes for our listeners who are tracking Japan markets. What are the key takeaways from today's discussion?
3 big themes. First, Fed independence concerns and dollar weakness are creating direct pressure on USD, JPY, with the yen likely to strengthen when markets reopen. That's a headwind for Japanese exporters and Nikkei performance. Second, the Trump credit card rate cap proposal is triggering a global financial sector sell-off, which will spill over into Japanese equities and may dampen US growth expectations, further weighing on export demand. Third, all of this complicates the Bank of Japan's policy trajectory, likely delaying any aggressive normalization and keeping JGB yields under downward pressure in the near term. For global investors, this is a risk-off moment, and positioning should reflect that with attention to currency hedges and sector allocation.
Excellent summary. As always, none of this is financial advice, and investors should do their own research and consult with their advisors. But if you're following Japan's markets day to day, we hope this breakdown is useful. Consider subscribing to TOI Japan Market Radio for daily insights as these stories develop. Thanks again for joining me today.
My pleasure. Talk soon.